Welcome to this analysis by Corporate Lab. We're diving straight into Bank of America's absolute monster of a second quarter for 2026 today. The bank just dropped a staggering $31.6 billion in revenue for the quarter. But hey, as anyone following the financial sector knows, top-line numbers only tell a fraction of the story. So we're going to break down exactly what drove this growth, segment by segment, to really understand the mechanics behind what might be one of the most critical earnings reports of the year. Just a quick reminder, this explainer is an objective, data-driven look at the primary sources, not a recommendation to buy or sell. Okay, let's dive right into this. We'll be walking through the headline numbers, doing a segment-by-segment breakdown, looking at NII and balance sheet health, the market reaction, the bear case, and finally, what to watch next. Let's kick things off with Section 1, the headline numbers. We're starting right at the absolute top of the balance sheet. Bank of America delivered a massive $9.1 billion in net income this quarter. To put that into perspective, that's roughly $100 million in pure profit every single day of the quarter. That is a 27% increase year over year. When a bank of the sheer size grows its bottom line by nearly a third in just 12 months, well, you know for sure something fundamental is shifting in its core operations. And the metrics we're looking at here really illustrate the breadth of that performance. Revenue, net of interest expense, rose 15% to $31.6 billion. Diluted earnings per share jumped 34% to $1.21, completely blowing past consensus estimates. But honestly, the absolute standout metric here is the operating leverage, which came in at a positive 6.6%. Simply put, their revenue grew way faster than their expenses. That pushed their efficiency ratio down to 59% and drove a seriously impressive 17% return on tangible common equity. Moving on to Section 2, segment by segment breakdown. Let's peel back a layer and see exactly where all that $31.6 billion in revenue actually came from. Now, what's really interesting about this is that in a pretty complex macroeconomic environment, it's super rare to see synchronized growth across the board. But this quarter, every single major business segment at Bank of America reported double-digit net income growth. This wasn't just one lucky division putting the whole team on its back. It was a completely synchronized effort. Let's compare two of their foundational pillars. On the consumer side, they brought in $3.3 billion in net income. Their average deposits were incredibly steady, basically ticking up 1% to $957 billion. But then, look over at Global Wealth and Investment Management, or GWIM. They pulled in $1.4 billion, but the real story is the client balances. They surged 12% to a record $4.9 trillion. That surge was heavily driven by strong asset management flows and higher market valuations. It really shows how BoA is capturing wealth generation right alongside everyday consumer deposits. Now, pivoting over to the institutional side, things get even more explosive. Global banking hit $2 billion in net income, and that was fueled by an absolute renaissance in deal-making. Investment banking fees skyrocketed 50% to $2.1 billion. Meanwhile, global markets contributed $2.6 billion to the bottom line. Their sales and trading revenue was up 33%, and equities trading specifically, that soared by a massive 70%, driven by heavy client activity and strong derivatives performance. This kind of institutional momentum was a huge driver of the quarter's overall outperformance. All right, on to Section 3, NII and balance sheet health. We're pivoting from segment revenues to the core mechanics of the bank's profitability and capital safety. So the heartbeat of any traditional bank is its net interest income, or NII. On a fully taxable equivalent basis, NII reached $16.2 billion. That's a 9% year-over-year increase. Now, you might be wondering, why did this grow so much? Well, the sources point clearly to the gradual repricing of BoFa's massive fixed-rate asset portfolio. As older, lower-yielding assets mature, they're being swapped out for higher-yielding ones in our current rate environment. It's essentially creating a really powerful multi-year tailwind for them. And when we zoom out to the broader balance sheet, the foundation here is just massive. They are sitting on a staggering $2.02 trillion average deposit base. I mean, that's basically the GDP of a medium-sized country, right? And that's funding $1.22 trillion in average loans. More importantly, from a safety perspective, their Common Equity Tier 1, or CET1 capital ratio, stands at a robust 11.2%. That represents $202 billion in high-quality capital, sitting very comfortably above regulatory minimums. Section 4, Market Reaction and Analyst Views. Let's shift gears and see exactly how Wall Street and institutional researchers interpreted these really strong numbers. As this quote from Hudson Labs points out, the initial market reaction was actually pretty nuanced. A blowout quarter is great, obviously, but analysts are incredibly focused on what comes next. As Hudson Labs notes, investors are looking right past this current quarter to figure out the future sustainability of that NII trajectory. They want to know if those incredible trading fees are actually durable and if management can maintain strict expense discipline while they keep investing in technology. On the more bullish end of the spectrum, research platform Ticker models a potential long-term price target of $76 by December 2030. But it is absolutely vital to catch the condition attached to this model. They explicitly point out that this target assumes the current operating margin expansion and that killer 15+% trading momentum actually carry through into the back half of 2026. Basically, they're betting it's a sustained trend, not just a one-off spike. That brings us to Section 5, the risk and bear case, because in any objective analysis, we have to look at the macroeconomic risks. So, what are the structural stress points that bearish commentators are focusing on right now? First up, there's a real risk that this fixed-rate asset repricing tailwind might start fading by late 2026. Second, you have ongoing industry-wide concerns about commercial real estate exposure and general credit normalization, which basically means charge-offs returning to pre-pandemic norms. Third, if interest rates stay higher for longer, it could eventually force the bank to pay out more to retain deposits, which would squeeze their margins. And finally, strict Basel III regulatory capital requirements and any potential slowing in middle market loan growth definitely remain key macroeconomic risks to keep on the radar. Wrapping up our analysis with Section 6, What to Watch Next, let's look at the variables that will shape the upcoming quarter. This right here is arguably the most critical question posed across the analyst reports we reviewed. BoFA enjoyed a massive 27% net income jump this quarter, heavily supported by NII. So the entire street is asking, does this repricing momentum hold steady through the end of the year, or does it start to fizzle out as we head into Q3? So, if you're tracking this space, here is your neutral watch list for Q3. First, keep a really close eye on management's official NII guidance versus their actual trajectory. You'll also want to monitor the investment banking deal pipeline, especially potential tech IPOs and M&A activity, to see if that 50% fee surge was actually durable. Pay close attention to credit quality metrics, like net charge-offs, to gauge the underlying health of the consumer. Watch for any shifts in Federal Reserve interest rate policy, since that basically dictates deposit costs. And lastly, track their capital return flexibility, specifically looking at how aggressively they decide to deploy that new $40 billion share buyback authorization. This analysis is independent research and interpretation based on publicly available information. It is intended solely for informational and educational purposes and is not financial or investment advice. As we look ahead, the ultimate question really remains, will Bank of America's fixed-rate momentum propel them safely through 2026, or is the higher-for-longer rate environment quietly setting a trap for their deposit costs? Thank you for joining Corporate Lab for this explainer on Bank of America's Q2 2026 results. Keep learning, stay objective, and we'll see you next time.